Good morning, guys. Hello, Todd Grossman. I'm here with Brandon Sparks, one of our lending partners with Barton Creek Lending Group. We'll see where this goes. Maybe this is a weekly thing. Maybe it's a monthly thing. Maybe you never want to hear from us again. Maybe we call it Bald and Balder. Who the hell knows? But let's have fun with this. We're in unprecedented times. We're not going to sit and hit you with a lot of stuff you're hearing all day long and drive you nuts, drive you crazy. Really, knowledge is power. And without knowledge, you really don't know where to go. This is not an intent to try to get business right now. This is not an intent to try to have you do anything other than be filled with knowledge and know when, if you're doing anything right now, what to do, what not to do. If you're thinking about doing anything when everything subsides. Obviously, spring and summer are the most opportune times to hit the ground running. So what I'm going to do is just a little bit of Q&A with Brandon here and try to get knowledge out there and see what we can do to help you as the consumer. So, hey, Brandon, good morning.
Hey, good
How
morning.
you doing?
Doing well, man. Thanks for having me. Really appreciate it.
Absolutely. So let's just jump right into this. We're going to try to make it quick, dirty, and easy for everyone to understand. So, I asked Brandon to try to help us out and understand really what the Fed cut means, what everything we're hearing. To me, I've been in this industry now 22 years, been recognized as one of the top brokers in a couple different markets. And even me, I need to be educated. I reached out to Brandon the other day when I heard about the jumbo loans, and I thought everyone was out of their mind. And unbeknownst to me, I got educated myself. So we're all being educated all the time. So even the professionals you're trusting in, unfortunately, don't know everything all the time, and we're trying to learn. So jumping right into that, Brandon, what this Fed cut, what does this mean to interest rates? What does this mean to the markets? What do consumers really need to know, and what do they need to understand?
Yeah, absolutely. So just a little background. I've been in the lending arena for 16 years on the back of an econ degree, a business degree in economics. And so this is right up my alley in terms of monetary policy. And the Federal Reserve, their key role is to protect us against inflation, to preserve the value of the dollar, and they do so with certain operations such as interest rate cuts and other things that we call quantitative easing. You've heard the term QE, and I'll talk a little bit about that. But interest rate cuts are primarily designed as aid to the banking sector, down to the 0 to 0.25, relate to what's called the discount window. It relates to the space that banks go to borrow money. It relates to the amount of time that these banks have to borrow in terms of like a 90-day window, for example, to borrow at these low to no cost basis points. It also relates to the overnight exchange rates that banks borrow from each other. And a lot of people don't know that based on depository activity, that banks are borrowing from each other overnight. And so the Fed cut rates to 0 to provide ample liquidity, to provide a flow of money to banks so that there wasn't a run on cash. If you look in your economic history books, a lot of the runs we saw in the past, for example, the Great Depression, were sort of a double whammy. It was the stock market failing and then a run on cash at the banks, which collapsed the system. So the Fed did a great job of getting in front of this, cutting these rates. And these rates, as far as consumers are concerned, will feel it with their credit cards. Those particular rates fall. Auto loans, if you go online and you look right now, interest rates for autos are in the 2s. So these have a direct impact. Now, mortgage rates are different. The 30-year, 20-year, 15-year fixed, all of the markets that we all know so well are not affected directly by the Federal Reserve. They don't control our rates. Mortgage-backed security, supply and demand drives interest rates. And when you get a loan, when you refinance your loan, you become part of an overall mortgage-backed security package. And on the secondary mortgage markets where these things are traded, the supply and demand of those particular aspects, that's what drives pricing. So where they have helped us in this recent monetary policy move was back to that quantitative easing that you and I talked about here briefly. And that is a move where they purchase the bonds from the secondary market in order to create a demand and help control this massive volume that we have kicking up as a result of the refinance activity that's going on today. So that's kind of an overview of how the Fed works and how they're helping supply liquidity to our markets.
So for layman's, just and correct me if I'm wrong, so people truly understand, the Fed cut is helping bank to bank.
Yep.
The only reason, and that actually raised interest rates because the sell off, and there was just too much out there, and people didn't want to take or banks didn't want to take the risk. And the only reason why interest rates now have dropped after that has happened is because of the bailout, and the bailout is putting a Band-Aid over things to bring the interest rates down a little bit, so we just don't have a market that completely crashes. Correct?
Yeah, there's I'm going to expand on that just a tiny bit and keep it succinct for timing. So a lot of times in the markets, the equities markets where people trade, they buy stocks, the Dow, the S&P, NASDAQ, those have higher levels of volatility. And sort of the opposite side of the coin is the bond markets, or are the bond markets, where you have the treasuries, the 2-year, the 10-year, the 30-year treasuries, mortgage-backed securities, bonds. When there's trouble or uncertainty in the equities, like the Dow, often institutional investors and investors alike will move from that marketplace over to a safer perceived market, which is the bond market, which is where we live as mortgages. So what actually drove the rates to fall was this increased demand for safer investments, this move to the bond markets. And if you go back to your old econ books, you'll know that supply and demand affect interest rates inversely. So the higher the demand, pushing the price up of the mortgage bond, the interest rates fall. That initially created the huge drop in interest rates, and that created the tidal wave of refinance activity. Capacity levels were tripped in the mortgage industry, and so artificially in our world, lenders were kicking up interest rates because they didn't have the capacity to meet all this demand, so they artificially raised rates, and that has stabilized in some capacity. But we saw probably 5 years worth of volatility in a matter of 2 or 3 days in terms of interest rates falling to the 2.9% range, and then all the way up to 4.75 in 5 days. It was incredible.
I guess that leads into the next question, which may be going fast forward too much, but it leads in pretty nicely. So if someone is getting a loan right now, whether they're in process or brand new starting tomorrow, what's sort of the timing process? How long are appraisers taking? What's going to be the process? Because the old norm used to be, at least for us out here in Austin, was 30 days was a cakewalk. And I called you and I needed something done in 15, 20 days. You would hedge to say, hey, give me a little bit more time, but you'd get it done. It sounds like now 30 days is the one that's like, oh my God, I may or may not be able to make that. What are you seeing right now?
Yeah, you're exactly right. I mean, in the days prior to COVID-19, it wasn't uncommon for us to be able to pull off a close in about 16, 17-day working days with a 30-day contract. Now, on a purchase in particular, we're planning for a 45-day rate lock period that will cover unforeseen elements. I mean, there's so many things that are changing on a daily basis, we all know, in terms of how appraisals are working, in terms of how title companies are working, in terms of the social distancing. And so we're planning on 45-day closes. We're exceeding that expectation, but at least if you're dealing with listing agents and buying agents and consumers, having a 45-day window doesn't mean we're going to delay the close. It means we're going to close you on or before that time frame. So we still may be able to achieve a 30-day close. But what I'm seeing is, because of this massive volume, this unprecedented volume of refinance activity, you only have so many appraisers physically out there in the market. you only have so many title companies out there, and the abstract work that they do to actually pull up the title commitment. So the biggest delays to our process, it's not always the lender. It's actually the appraisers. Sometimes they're taking 15 days right now to get me a report. So I could be thoroughly down line in 10 days on a submission package with all the credit stuff. But the collateral being the house, I need 2 weeks for an appraisal right now. And we're waiting on title companies to produce these title policies. We've expanded our repertoire of preferred partners. So we have 3 or 4 groups working. We have multiple AMCs working with the appraisal side. And we're shopping it out just like a broker would to see who can turn these things. And by the way, purchases do get preferential treatment over refis. That's always how it's been. But typically the hourglass has been turned over on a purchase. Refis have a little bit more time. They're already in the house. But if I can just say to all of those out there looking to buy, looking to list, have a little bit of flexibility in your timeline right now, because these things are changing and we have to work together. We all want a smooth transaction, and good communication will allow us to do that. We can update you guys through a process day by day, week by week as they evolve.
So I want to expand on that a little bit. As Brandon said, keep in mind, you guys are all at home, you're sitting around, can't figure out what to do. Your title company's doing the same thing. Your title company is not allowed in their offices. They're working on a skeleton crew. They don't have all the resources at their fingertips. It's taken them more time. They can't pull abstract documents like they could in a matter of seconds. So you got to be patient with them. And there's no pointing fingers here. Everyone is doing their best to get this done. But on top of that, I've got a closing happening this week, and everyone's going out to mobile notary. The soonest mobile notary that was available on the first go around without us pulling every trick we had was April 13th. Today is March 31st, guys. Wow. They are supposed to close on the 2nd. If they're supposed to close on the 2nd and we do not have a mobile notary till April 13th, you see the problem there. And we have zero control. All of us have zero control. We're all trying to work together to make this happen. And there's going to be a lot of frustration, a lot of angst, because a seller is wanting to sell their home. They're under contract. They're supposed to close on a certain date. They figured out what they're going to do with that money. They may be buying another home. They may be stressed and want that as a safe harbor to put in the bank until this thing plays out. There's so many different reasons, but keep in mind that no one is trying to delay the process right now. Everyone wants this done as quickly as possible. And remember that no one gets paid until the deal is done, funded, and cross the finish line.
Absolutely. And, Todd, to your point, there are steps in the process that a lot of people don't know about because we just don't need to bother people with a lot of the weeds of the process. Verifications of employment. There's a perfect example of one. In the process towards the end of the closing, we're verifying that a borrower is still employed. And this is, critical right now, especially, and we can expand upon this later if you want to, but we've allowed some changes to the guidelines in terms of how we're verifying, because a lot of HR departments aren't in shop right now. They're, we're allowing certain, sort of enhanced measures for the appraisal where they can just drive by the property instead of accessing the property. And I've even heard of title companies opening the doors, as you said, with a skeleton crew, having an office dedicated to just the buyer, having a speakerphone on, having specific pens that the buyers can sign with and take with them, the closer actually being in the other room. So they're communicating without having to touch. So we're finding all these ways to get creative, and we're pushing our investors right now to try to accept what the Texas legislator has just passed, which is, it's abbreviated RON, RON, or remote online notarization. So we're trying to make a huge push to change the industry norm where we can do all of our notarizations in a format who's a notary, and allowing us to verify that person and sign closing docs. So we're still in the process of advocating towards that and making progress every day. Nice.
Now, one thing that a lot of consumers got a little anxious about back in 2008, 2009, or actually after 2008, 2009, Obama administration kicked in and really protected us realtors, lenders, consumers, which a lot of people were okay with cooking to the books of appraisals and things of that nature. The nice thing is there were some regulations put into place that appraisers need to appraise properties for what they are worth. Lender couldn't call, realtor couldn't call and say, hey, I need $10,000 more in value. Can you make this happen? Again, a lot of people didn't like that happening. To me, coming from Vegas, I thought it was the most incredible thing done. That has inhibited us a little bit of the industry over the last 5-10 years, and the fact that we need an appraisal done and it needs to go to a review committee, and we may get an appraiser in San Antonio, we may get a review, or I'm sorry, it goes to a portal, and we may get an appraiser from Dallas. And you had little control over who the appraiser was, which was great. In times like this, are they allowing you, the lender, to open up your Rolodex a little bit more and maybe find an appraiser that can get it done sooner, or are we still dealing with the same quality control that was put in place?
Yeah, the same quality control is in place. It's called the Home Valuation Code of Conduct, and that was established in, I believe it was 2009, as when they kicked that into full gear after the collapse. As a result of that, we order our appraisals through appraisal management companies, AMCs, and part of their sort of requirement is to have local appraisers on the Rolodex. And so we stick with a very small handful of appraisal management companies. There's one in particular that I really like to use, that the owner is a local here. He's been in the market for 25 years. They've got about 15 different appraisers. They only focus on this sort of Metroplex area. So maybe as far down as, Buda, Kyle, Dripping Springs, and then up north to the Pflugerville, Georgetown arena. So very localized, very experienced, all the way out to the lake on the other side, and then on the east side as well. So we have the flexibility to be able to control that aspect, and that's proven to be one of the most confidence building aspects of our process. When we can talk to the non-appraiser. So I can talk to the managers and say, look, here's this property. Here are some comps from the area that the realtor has provided. I know you guys need to evaluate these comps and make sure that there are other properties that are of similar square footage and view and quality of construction and age and finish out. But let us know if you see any issues early, and then we'll talk with everyone in the process to see what we can do. So that allows us to have that higher level of communication with it, which is what it's all about. We can't say, hey, we need this value to come in 10,000 more. And they won't do that. But at least having these local resources where we have a lot of experience working with these people, we do have a line of communication. And these sources are much better than just going online and trying to pull up a Zillow, price estimate, or going to the tax records. Those aren't reliable measures. Those don't follow the standards and procedures that we have in the industry. But we do have those resources available to us all.
Very nice. So the point of this call or video conference is not to kill all your guys' time. So I do want to try to get a couple of more just very important questions answered. And especially to the consumer to understand, wealthy people need to know right now, anyone needs to know, but wealthy people that sometimes feel that you're completely invincible because you got great credit, you got money in the bank, you got a thriving business, that you can just call up the bank and get a loan. This is the most important question I have for Brandon to answer right now, for people to really truly understand what is going on in our mortgage industry. Because for me personally, this is 50 to 70% of my clientele. If my clients aren't paying cash, they're getting a jumbo loan. And where I was going with this and leading into is people that felt invincible, that did not worry, they weren't living paycheck to paycheck, and they could just go down to their local bank and get a loan on anything that they want. In normal times they could. I want Brandon to explain a little bit and try to help the consumer understand as quickly as possible what is going on with the jumbo market. And consumers, just so you understand, the jumbo market is to buy, well, I'll let Brandon expand on the loan limits and understand what a jumbo loan is, and then explain what has went on in the process, if you can.
Okay, I'm going to try to be very quick with this. A jumbo mortgage is a class of mortgage. And of course, as lenders, we sell loans to the secondary market. So I want you to, in your mind, think of the image of a highway with multiple lanes. Each lane represents a particular type of mortgage or mortgage-backed security. You've got your Govy loans like FHA and VA loans. That's a particular lane. You have conventional Fannie Mae agency is what we call it. So Fannie and Freddie, and that's a lane, and that represents essentially about $75,000 loan amounts all the way up to $510,400. That's that lane. Once you get over 5, 10, 400 and a dollar and beyond up into the millions, you're in the lane that represents jumbo. Each of these lanes have their own rules. It's kind of like checkers and chess in terms of how the rules are played and how we underwrite these loans. So these different rules relate to the investors that are buying the loans on the secondary market. There are other lanes which I'll stay away from for now. But in this particular time, with the fear that is sort of affecting all of the secondary markets, we have a lot of pullout. We have a lot of essentially collapse within these ancillary markets that aren't backed by the Fed purchasing mortgage-backed securities. And right now, the Fed is dialed in a protocol that was set forth in 2008, which is the qualified mortgage safe harbor for Fannie Mae and agency. So Fannie Mae, 100,000, 75,000, all up to 5, 10, 400. They're buying billions of those mortgage-backed securities. That's keeping the system moving. Jumbo, on the other hand, doesn't have that luxury. So Jumbo is almost in a frozen status, along with several other niche products. So walking, as you had said, into your bank and just thinking that you're going to get a jumbo loan, or calling a lender like us, you may not have that access presently. Those markets are frozen until later notice. So now I can talk at the end of this about some of the enhancements that we have as a firm in particular, but be cautious, because this isn't just harming this COVID-19 event isn't just harming, the folks that are serving us at our restaurants and the people who are not as wealthy. It starts there and it makes its way all the way up to the wealthy, in that it's affecting everyone. This does not care what color you are, how much money you have. This is affecting all of us. So those markets may not be available to many of you out there as you go out there and seek that kind of financing.
Which is very important. And again, I part of this is, not trying to get business. I will let Brandon or I'll ask Brandon to speak a little bit on how they're a little bit different, which is great, to speak on this. But the main part is to understand, as Brandon mentioned, no one is immune from this. And when I say that, life as we know it will be changed. Life as we knew it pre-2008 has been changed ever since, in our industry. Life after 2020 COVID-19 will forever be changed in our industry. There will be changes that will be made for the long term, that some will say don't make sense, some will say make sense, but it is what it is and we can't change it. Right now, in this day and time, while the evolution of every day happens, every consumer that is trying to buy or sell real estate is being affected, no matter color, race, religion, sexual origin, amount of money you have in the bank. From 0 to 100 million, everyone is affected.
Absolutely.
To try to shorten this up and just jump to the end, let me ask you, Brandon, and I'm getting calls several a day from clients. What's going on in the market? What do you see happening? Where are we going to be 6 months from now? My honest opinion has been, and what this is going to lead into is, should people buy right now or not, is I don't know. I can only say I do not know. I can give you my opinion on what 6 months from now is going to be. And quite honestly, every day is going to be different until this is over. If I answered it today and this ended today, I have a very good feeling that we'll bounce back relatively quickly in Austin, Texas, due to low interest rates, due to low inventory. But every day this progresses, and the more that jobs are lost is going to be the $50 million question I can't answer right now until this is over, until we know how many jobs are gone, until we know, in Austin at least, if jobs are gone, how long are they going to be refilled? Again, this is right now, this Austin, and I'm speaking out of context, this is not found in the Wall Street Journal, so I may be completely wrong. But in my opinion, we are the heart of the tech industry right now. There are more startups in tech. There are more business there's more business happening right now in Austin, Texas, pre-COVID-19 than many other places in the continental United States. So when we do start back up, we're all going to be affected. I don't care where you live. We're all going to be affected. But my true honest opinion is Austin is going to rebound much quicker than most markets in the country that we're already feeling, like San Francisco, New York. We're already feeling a compression due to taxes, due to all kinds of circumstances in their areas where we weren't. We were thriving. We had a limited amount of inventory. Now that builders are not allowed to build during this COVID-19, we're not increasing inventory. There's still going to be a demand. What's that demand going to be when this all plays out is the question. And I do think the consumer demand will be there, but will they physically be able to purchase a home? If you're not working, again, I can't speak for myself. I can speak for myself. I can't speak for you. And I don't know how lenders are going to look at this, but if we now have a consumer that hasn't worked in 3 months and hasn't paid their bills, you as the lender, yes, you're going to look at it as just like in 2008 and 2009 when not everyone, quite a few people had foreclosures and bankruptcies, and you're like, all right, they're one of another. It wasn't like 2020. If you have a foreclosure or bankruptcy, you're on an island by yourself. Back in 2008, 2009, you were almost the odd man out if you didn't have a foreclosure or bankruptcy. So you were sort of forgiven. With that being said, I don't know how this whole thing is going to play out. If you look at, we go into July and you see someone that has 3 months of missed payments and hasn't worked, how's that going to play out? I don't know. So I guess the main question here, and sorry to be so long-winded, is
that's great.
Is this the right time to buy, and what are your thoughts there?
So I agree with what you're saying wholeheartedly in several elements that you just mentioned, including the fact that we just don't know. I don't even think the administration knows. This is such a novel experience. It's such a new experience to the human race that, it's unprecedented. In the past, we've had several events where we call them extenuating circumstances. And my gut tells me that as far as lending goes, when we look look backwards at late payments that were received or missed payments and lost jobs and time off the work, we'll write letters of explanation. We'll describe this to the underwriters in that this was a government-imposed recession to keep people distant, to shut down business in order to save lives. This is the most extenuating circumstance of the last 100 years. So I think that there's going to have to be some understanding in the underwriting realm. We haven't really talked about a lot of that yet. It's kind of like being in the battle and triaging loans and, looking at what we can do right now to help move the ball forward. Just keep the housing market afloat, essentially, because we don't want to stop lending and add to the economic woes. So to your point with Austin, look, there are only so many squares on the chessboard, right? Land is finite. It's a wonderful time to buy in terms of interest rates still. I mean, rates are still in the 3s, in some cases in the 4s. This is not going to last forever. A lot of people are kind of stuck in the moment, and this will pass. We will find ourselves at some point in the early summer and the late spring where we're back out there. These jobs that have been lost, they're going to have to find a job somewhere else. People are going to get back out there and go to restaurants. And so Austin is an incredible place filled with incredible people. You had mentioned how we have a wonderful tech industry. Oil will eventually come back. We're still, on the map in terms of Austin being a hub for some of the oil activity. We've got the local government that's here. We've got all these schools that are here that has so much talent, the medical industry that's here. So we will bounce off of this, and it's going to snap forward with that pent-up demand. People are going to travel again. I think we're going to see an incredible economy. When, we don't know, but it's coming. You guys are probably tired of sitting at home, and we're all feeling that. So the demand will come back. We have the best banking system in the world. So they're doing everything they can, these unprecedented measures to put money into folks' pockets. I think we will find ourselves in a good spot. And again, buying property right now, if you've got the means, if you've got a solid job, it's a great time to get out there. You're going to help push the economy forward by going out and buying now, getting yourself a good property. And frankly, there's probably a lot less people out there. So you may have a better shot at getting that house that you wanted before than more than ever. So that's my take on it. I think we just all hang in there. We find creative ways to work together, to do virtual tours, to keep a paperless process like we have on the loan side, and keep pushing forward.
I agree. And one thing I'll say on that with Brandon is, if you were looking at homes in Austin, Texas, the first quarter of this year, it was crazy. It's been crazy. Up until COVID-19, multiple offers in almost every area of the city. It has become extremely competitive. So interest rates are down. We don't know where the bottom of the market is, but the bottom is never going to be found unless you're lucky. If everyone knew where the bottom was, you'd be the smartest person on the earth, and you'd be the wealthiest person imaginable. We don't know where the bottom is. All we can go off of what we know. Will values dip a little bit? I do think so. How much? I don't know. But if you're looking to be here and live here and raise a family here, who cares where the bottom is? You're going to recognize the up no matter where you buy right now. I believe in Austin, Texas. Where I was going with this is we've got so many resources out there virtually, and with any broker, this isn't a time to plug myself, but with any broker, a good broker that is there to protect you and represent you, you can go find a home, negotiate on it virtually, write into the contract to go look at it, and have the right after you view it physically that you can pull the contract. Sellers are eager to sell right now that are on the market and need to sell. You can probably negotiate and get the home that you want without being in a bidding war. Now, are you going to get a deal? Who knows? Every seller is going to be different. Every situation is going to be different. But it'll be nice that you can actually go and buy a home as you did pre-real estate boom and be able to look at it several times virtually. Have a conversation with your spouse, with your significant other, with yourself, with your kids, and make sure that this is a house for you. Negotiate a price, negotiate terms, negotiate being able to go see that home once you're physically able to go inside, and continue doing what you're doing. As Brandon stated, this is a time to help resurge the economy. Austin is going to be an aggressive real estate market once again. I feel very confident with our lack of inventory and the demand and desire to be here. Even if it wasn't for any of our tech industry, our work, our jobs, Austin is still a very sexy place where people want to be, and they're going to come. We have a very beneficial tax structure. People are going to come here. So you can wait. And by all means, everyone is going to have a different opinion here. And I'm not telling you should or shouldn't. Depending on your means, it's entirely up to you. But if you wait till the summer, once this all passes and you're trying to buy the home of your dreams, you more than likely are going to pay more than you wanted to pay or could have paid today. Chances are interest rates are going to go up from where they are today. So we can only go off of what we know today. And my recommendation would be is, if you need to be here and you want to be here, then do everything in your power to be here. If you're nervous, if you don't know what your job is going to bring to you, then take your time and let everything play out. Again, it's a case-by-case basis, in my opinion.
Absolutely. Just to add one little thing about the lending side, when you're out there shopping for a mortgage, one thing that you want to ask these days that you never had to ask really, not at least in the last 12 years, is, does your lender have the capacity? Do they have the ability on their warehouse lines to fund a loan? And have those dialogue questions with any lender that you're talking to or any bank. Get out in front of the process. Get pre-qualified early. Make sure the bank is pre-qualified and that they can lend to you on these products that we talked about earlier. These jumbo loans and different products of that type. It can make the difference, in your peace of mind.
So one last thing I want to say there on that note, and then we'll try to get this call wrapped up as it's been a little while, is I was through real estate in the boom of Las Vegas where anything you touched turned to gold. And they were lending to anyone that had a pulse. I will say though, we were in the days when every lender imaginable would throw something against the wall and hope and pray it would stick. And unfortunately, there was a lot that stuck, but there was also
Hmm.
some that didn't, and wasted precious, valuable time to the consumer, who, when you look down that pipeline, hurt the realtor, hurt the appraiser, hurt the title company, hurt the seller that was trying to sell the home to that buyer with the preconceived notion that just because they had a piece of paper that said they were approved, that they were approved. This is the most important time, because we're back into those times. We're not in the boom, but we are in a state that lenders are not all created equal right now. And with
Hmm.
that being said, they might be the most honest, straight going, forthcoming person in the world, but where they are working, they do not have the capacity to get loans done because of restrictions. So here's where the shameless plug. I'll let Brandon speak a little bit, to sort of speak on Barton Creek Lending and explain where they're situated and where they are in a short period of time, just so you can understand that, again, if you're shopping for a loan, go with who you feel
Hmm.
comfortable with, but go to someone that has knowledge, experience, and has the ability to fund your loan.
Yeah, absolutely. We weathered the storm in 2008. We were lending on non-traditional loans at the time, condos downtown that were not considered eligible for traditional financing. Presently, we're still in a position where we use those sources. We call it portfolio lending. We're not selling those loans to the secondary market, and so that buffers us greatly. We have huge capacity to still fund in the jumbo realm, so over 5, 10, 400, up into the millions. Those channels are secure. We have a bump to our credit line for any Fannie Mae agency loans, so we've been bumped. We got way out in front of this, and have a huge capacity to fund on a monthly basis. Any volume that you could think of throwing our way, we can handle that in terms of loans that are Fannie Mae, that 510 or less range. We have a paperless process. We always have. So we make that easy. You can essentially qualify from your kitchen, from your bedroom, on a laptop, on a tablet. We collect documentation securely with an online military-grade encrypted portal. We're doing verifications verbally on the day of closing. That's one of the biggest enhancements we've had. But we call your employer. We get an email from them making sure you're still employed. We can still fund on that basis. The appraisals, we talked about that. We're ordering those. We're allowing, in some cases, just an outdoor sort of drive-by external appraisal. So we're trying to keep with it as much as possible. We're trying to help folks with regards to the mobile notary process, and just being available, having, given my cell phone out to my clients on a regular basis anyways. I always used to joke, if you text me or call me late night, or even on, Christmas Eve, I can walk outside for a few minutes and talk to you if you have a mortgage emergency. So just being present and talking to people through this process, educating. We've always, kind of come from that position, and more so even right now, to help calm fears.
Awesome. Well, guys, I just wanted to say thank you, Brandon. Thanks for being here and
Thank you so
lending
much. Yeah.
your ear. Guys, you can reach Brandon Sparks at Barton Creek Lending at 512-796-4569, or Brandon at BartonCreekLending.com. Again, thank you, Brandon. This was Todd
Thank you
Grossman
so
from the
much.
Grossman Jones Group, and just want to say, hey, hang in there. We're all in this together, and stay at home. If we can fight this sooner than later, we'll all be back on the streets and pumping the economy back up. So thank you again.
All right, buddy. Thank you so much, Todd. Really